So I think it's time to kind of buckle up and get ready for some enhanced volatility. But it's to be expected. When you're investing, there's always going to be volatility. And so, I just want to cover that, go through that slide just because, put it in perspective that there's always going to be some news, some headline, something that's going to, cause that uneasiness or, some sort of volatility in your portfolio. So, kind of move on from there. I want to touch on some of the retirement savings new rules. So, with the Secure 2.0 that came out a couple of years ago, the IRS, they finally came out with their final regulations on this. And I know I covered this in a separate video and really highlighted the inherited IRA rules, but there were also additional rules that were changed and will be changing over the next couple of years that are important for you to be aware of. So one of the big ones was that, starting in 2026, if you are over 50 years old, you're eligible for the catch-up contributions. However, starting in 2026, if you make over $145,000, you're now going to have to make those catch-up contributions into Roth accounts. So this is a pretty big deal because now it takes away the ability for some of that tax planning for those that are higher income earners. Typically, they don't want to contribute to a Roth because they're at that highest tax bracket already. Now, on the positive side, where this really does help is that, what I've seen over the past couple of years is that people who are entering retirement, as of late, they don't have as much in Roth accounts as they wish they had because, during the savings years, it's always tough to contribute to a Roth account because it's after-tax dollars. It's hard dollars going into those accounts. Whereas when you're contributing pre-tax, you get that tax deferral, you get the ability to let that compound for a long period of time, and it feels good in the moment. But now, as you're entering retirement, it's the opposite. A lot of people think of, well, I wish I had something I can get some tax-free income from. And that's where the Roth comes into play. So, this kind of forces that direction, but it is something to keep in mind if you are, over the age of 50, or going to be in 2026 and you're in that higher income earning bracket, you're now going to be forced to make contributions into the Roth. And, on top of that, that annual income amount is going to increase. It's going to be indexed to inflation. So it's something that will continue to go up. So as as your earnings likely go up, so will that. And, it doesn't impact, Roth IRAs. It's not going to impact, your spouse's income doesn't have any impact on this change, but it's just something that if your, individual income is over that amount, it's going to have to go into a Roth account. From there, the next update is that there is no longer RMDs from Roth 401ks. Now, this may be confusing because you might be thinking, well, Johnathan, I've got a Roth IRA. There's never been an RMD in that account. Well, that's true, but in Roth 401ks, they actually did have mandatory distributions because it was within that 401k account. And my guess is that, this was something from a record keeper standpoint. So whether it was, wherever your 401k is held, there are probably some issues around separating those dollars and creating the accounting to make sure there were no RMDs, but now there's not going to be any of that issue. They're going to align the regulations as they are with Roth IRAs. This is something that, in my opinion, should have been done a long time ago. So they're finally getting around to it. So that's some good news there. Next one, so spousal beneficiaries. This really applies if there's an age difference between, the spouse and, the beneficiary. So if you're married and your spouse is, significantly older or younger than you, what happens is if the older spouse passes away and the younger spouse now inherits that spouse's, retirement account, it's going to be treated as if it's the younger spouse for RMD purposes, which is a huge benefit because now, the RMDs don't have to be taken until, the deceased spouse would have been 73, but, you're also going to be having, the RMD age increase over time to 75. And this allows for this huge potential for continued tax deferred growth. And this really is going to be a benefit for, like I said, those that are, have a spouse that is significantly younger than them. If they inherit your account, they don't have to start taking distributions right away, even if you were subject to RMD. So it's a very big benefit. It's something that probably shouldn't have been done a long time ago, but at least, from a spousal standpoint, they should have more regulations and rules that, that really help, just like this one. And I think this is a great change that they're making. Reduce penalties for RMDs. This is a big one. So before, if you were to miss a required minimum distribution, even by 1 day, it was a 50% penalty. Now, it can actually be reduced to 25%. And there's ways that you have to go through, a couple different, channels to make sure that you are qualified for it. But you can actually get that penalty down to 10% if you do miss the RMD. So no longer is it this 50% penalty, which was, a huge cost. It's now can go as low as 10%. So really big deal here. I still would try to do your best to not miss an RMD. And especially if you've inherited an IRA, over the past couple of years that's subject to that 10-year rule. There was a lot of concern and questions about whether or not RMDs are required during that time frame. We put out a complete separate video dedicated to that inherited IRA rule. So make sure you check that out. But getting this penalty reduced, big cost saver, big tax saver if you do end up missing an RMD. Starting soon, employer matches can now go into Roth contributions. So once again, this is a great way to start adding some of that Roth dollars to your retirement. The key here, though, is that you will have to pay taxes in that year on whatever that match is. So from a tax planning perspective, just be aware of that. It's a nice way where, that match, because it's not something that goes in your bank account, then you have to see it leave your bank account, go into a Roth account. It's just something that your employer puts in there. It's an easy and default way to start contributing to a Roth if you haven't already. However, that income tax could creep up on you. So it's something that you just want to make sure you know well in advance that whatever that employer matches, you're going to have to pay taxes on that amount at some point, on that match. So just keep that in mind as you, if you are going to make that change. My guess is this can take a little time for employers as well as, plan administrators to catch up and be able to make this, actually applicable, because, there's going to be a lot of tax documents that need to be put out, a lot of changes from a payroll perspective. So my guess is that this is going to roll out, probably a little slower than most people anticipate, but it's something that will be changing. And now you have that ability, especially if you've decided that, you're at let's say, getting close to retirement and you want to put the majority of your contributions into Roth. It was always frustrating that you had to get these matching funds that were in a different format. So now this changes that. It allows you to control, have a little bit more control on where you want the money to go. So I think anytime you get control is more beneficial. It's interesting that they decide to give you more control here, but yet they decide to take away some control if you're earning over $145,000 and doing a catch-up contribution. So there's always that give and take there.